Good day everyone, I'm Nerjana Bagonte and I will be discussing the accounting ratios. What is accounting ratios? Accounting ratios is an important subset of financial ratios, are a group of metrics used to measure the efficiency and profitability of a company based on its financial reports. It is a way of expressing the relationship between one accounting data point to another and are the basis of ratio analysis. An accounting ratio compares two line items in a company financial statements, namely made up of its income statement, balance sheet, and cash flow statement. These ratios can be used to evaluate a company fundamentals and provide information about the performance of the company over the last quarter or fiscal year. Analyzing accounting ratios is an important step in determining the financial health of a company. It can often point out areas that are bringing the profitability of a company down and therefore need improvement. The efficacy of new management plans, new products, and changes in operational procedures can all be determined by analyzing accounting ratios. Accounting ratios also work as an important tool in company comparison within an industry for both the company itself and investors. A company can see how it stacks up against its peers, and investors can use accounting ratios to determine which company is the better option. And these are the types of accounting ratios. First is gross margin and operating margin. Second is debt to equity ratio. Third, the quick ratio. And last is dividend payout ratio. Gross margin and operating margin. The income statement contains information about company sales, expenses, and net income. It also provides an overview of earnings and the number of shares outstanding used to calculate earnings per share. And for the gross profit, as a percent of sales is referred to as gross margin. It is calculated by dividing gross profit by sales. And for the operating profit, as a percentage of sales is referred to as operating margin, and it is calculated by dividing operating profit by sales. And for the example, if the operating profit is 60,000 and sales are 100,000, the operating profit margin is 60%. And for the debt to equity ratio, and the balance sheet provides accountants with a snapshot of a company capital structures, one of the most important measures of which is the debt to equity, and it is calculated by dividing debt by equity. And for the example, if a company has debt equal to 100,000 and equity equal to 50,000, the debt to equity ratio is 2:1. For the last two types of accounting ratio, the quick ratio and the dividend payout ratio. The quick ratio, also known as the acid test ratio, is an indicator of a company's short-term liquidity and measures of company ability to meet its short-term obligations with its most liquid assets. And dividend payout ratio. The dividend payout ratio is the percentage of the net income paid out to investors through dividends.